All right, everybody, welcome to the latest episode of the Sherman Show. Today is August 2nd, 2022. I'm Jeff Sherman, along with my co-host, Sam Lau.
Hey, hey.
And today we are on the YouTube once again, youtube.com/DoubleLine Capital if you're listening to this audio and you want to see Sam's pretty smiling face today. And you can also catch a glimpse of today's guest. And our guest today is none other than David Wong from CIBC Asset Management. David is a managing director in the Portfolio Solutions Group for manager research and investment oversight. David, welcome to the show.
Thanks for having me, Jeffrey. Good to see you.
Yes. So Sam and I know you as you lead the investment team that's responsible for, researching, recommending, monitoring both the asset allocation as well as manager selection within CIBC Asset Management. So maybe you could tell us a little bit about our listeners who may not be familiar with CIBC Asset Management and your role within the organization and how you fit in the overall organization as well.
Yeah, so thanks again for having me on the program. Real pleasure to be on it. I'm a happy listener. I always like long form sort of discussions on investment topics. So appreciate the work you guys do, and really like Sam's his hey-hays. I might have to co-opt that as an introduction for myself in the future meetings.
Yeah, well, one of our colleagues stepped in on Sam's other podcast that he's moonlighting on, and again, been cheated on me for about 2 years with. And that person dropped a hey to try to do that. And Sam retorted quickly that it sounded more like Fat Albert. So, right. I think Sam has a sweet spot there, and I think it's trademarked already. So.
That's too bad. That's too bad. So at a high level, CIBC Asset Management, we're a $200 billion asset management firm here based in Toronto and Montreal. And so 200 billion makes us one of the largest asset managers here in Canada. We are owned by CIBC, the bank, Canadian Imperial Bank of Commerce, which is an institution that has 150 years of history. And for US listeners that might not be aware of the Canadian banking sector, because it's a little different than the US banking industry, we do have more of a bunch up of our banks here. We've got what's colloquially called the Big Five banks here in Canada, which has something like 80% market share. And you compare that to kind of how fractured the US banking market is. So a lot of that traces back to the origins of our banking founding fathers, very Scottish in roots. So we had a branching system early on, whereas the US system resisted branching. I think for a Canadian, it's interesting to hear that branch banking wasn't actually a thing across state lines until fairly recently in modern history. So just an aside on that front. But thinking about kind of the expanse of our bank, it really allows an asset manager to make use of a lot of great resources and have access to a large client base across the country. So we've got 45,000 employees of our bank, 11 million customers, and over 1,000 different banking centers. So a very large institution, great hardworking people. It's great to be surrounded by the people that work side by side to be client focused every single day. CIBC Asset Management specifically, if we can drill down to that level, we've been in existence now for the past 50 years. So we got our start back in 1972 as another firm. It was called Tal Global Asset Management as in our early years, and it was a very institutional focused pension plan manager. That our bank acquired an initial stake in kind of the mid 90s and completed the acquisition kind of in the early 2000s. And so the foundations of our organization, we've got this institutional backing. We have capabilities across equities and fixed income, as well as multi-asset and currency. And we serve clients, whether they're personal and business banking clients, otherwise known as retail banking clients, high net worth clients through a variety of different channels, including family office, bank family office, and institutional clients as well, which is obviously a high hurdle, right? There's lots of hurdles to overcome when you're winning institutional mandates. So I think that's a big stamp of approval of our internal capability. And then to supplement that, and more maybe to my role, we've got a manager research team that I've got the honor of overseeing. It's part of that mouthful of job title that you put out there: portfolio solutions, manager research, and investment oversight. So the manager research component, for the audience that might not be aware of even the concept of manager research that exists in our industry, it's the idea that you could have a team of investors go out and analyze managers around the globe, and we do this with our own internal strategies as well, and pick them apart and try to find differentiation and ways to find the best solutions for clients that best fulfill their investment objectives. And so the portfolio solutions aspect of my role really sees me kind of being the quarterback in many ways across all those great capabilities, and just thinking about how to piece all those things together and turn that into managed solutions or portfolio solutions that can help our clients better achieve their ambitions.
Yeah, I think I want to focus on that part on the portfolio solution side, because I think that's what a lot of people are looking for these days. But I think there's one unique factor about the Canadian banking system that I think you neglected to mention, and that is King Street in Toronto. They're all lined on King Street, and I feel like they're within 2 blocks of one another. Is that an appropriate assessment?
That's a fair assessment, maybe a slight refinement, because some of them are on King Street. Bay Street would be the main street. That's our version of Wall Street. So,
okay.
Yeah, so it's primarily Bay Street, but the intersect of King and Bay would certainly be
King and Bay. Okay.
Yes, the corner where a lot of banks are.
See, that's where I needed you to set me straight to there. So I guess I have the Queen, the King in there, and I forget it's Bay that is the main place too, though.
Actually, I should put a plug in there because we have a new headquarters on Bay Street, so we've moved further from King Street. So CIBC Square is an exciting new kind of building that we have downtown Toronto. It's right on Bay Street, but much farther from King Street. So there's this new vibe going on in Toronto, kind of well south of King.
Okay, awesome. Well, the next time we get up there, you're going to have to show me around. And so, let's talk about portfolio solutions and like, how do you think about that? Do you go into like the modern portfolio theory framework? Are you looking for things that you determine seem to be like a hole in your lineup? Are you trying to think about, kind of the next step of what's going on in financial markets, or is it really driven by like financial advisor demand, which is helping you with those recommendations as well? So how do you think about the confluence of those 4 kind of attributes there?
Yeah, so it's a combination of all of those things. You could, take a portfolio solutioning with a very kind of scientific sheen and try to over optimize things, but that tends to work in a back test, but not in the future. So you need to have some creativity to certainly think about where the puck might go, as Wayne Gretzky once said. So we take, I think, a very process-oriented approach to things in general. So we will set out kind of long-term forecasts as a starting point for all of our managed solutions or portfolio solutions. We think about all asset classes around the globe, certainly have access to that in our toolkit, whether it's internal or external, in terms of the management of it. And so we model out those returns. We have a separate team that does that, that looks to set up long-term strategic asset allocation forecasts. And from that, there's a bit of an optimization, bit of an art, bit of a knowledge and awareness of the global markets in terms of the market cap weightings out there. What's the opportunity set? And then we will supplement that with kind of that subjective assessment of where the puck might go. And so to that end, to your point on talking to clients, are there holes to fill in our various portfolio solutions? I think maybe one of the areas that might be further explored in the future would be in the realm of alternatives, as an example, where our regulatory rules in Canada have been a little bit tighter than what you have in the US for a very long time. The 40 Act would be kind of mutual fund rules in the US. Here it's National Instruments 81-102. And there's recently been revisions that allow for a little bit more latitude in that. So we haven't quite seen the full use of alternatives yet in managed solutions programs or just investment portfolios in general here in Canada. But I think that certainly will be a part of the future.
So there has been a big push here in the US of, kind of straddling that fence between what people would call the traditional space versus alternatives. And alternative seems to be a catch-all for anything that's not traditional, I guess, by definition of the word. But we've looked at the different structures in the US, we've seen kind of an evolution of that 40 Act. You've seen like the open-ended mutual fund, the daily liquidity vehicle. You've seen the more extreme version, the closed-end mutual fund, which is a lockup vehicle for, it used to be an infinite amount of time. Now they're finite life deals. And we've seen the hybrid get introduced too now, where there's something in the US what's been very popular with investors called the interval fund, right? Where, there's the ability to subscribe very frequently, but the redemptions are a little more infrequent, which allows that hybrid world. So when you think about like this introduction potentially of alternatives, do you think about it as the asset class structure? Is it due to liquidity? How do you kind of square that circle, as I heard Sam say the other day on that other podcast?
Yeah, so this is where it gets into modern portfolio theory a little bit, right? You're thinking about the utility of what you're introducing, and so it's either enhancing returns or reducing risk, and I guess the interplay of the assets really being important in that discussion. And so those are the lenses that we use when we're looking at different vehicles. So traditional versus alternative, I'd say, there's a decoupling of beta certainly from when I think about some alternatives, certainly hedge funds would fall in that category. And then you have a whole separate category where just even getting access to the asset class itself is there's alternative methods to do that. So private asset classes don't fit into traditional asset class categories neatly because of liquidity, because of difficulty of access and that sort of thing. So we view it from all those different lenses, and when we're thinking about how to or what to include in portfolios, I think it's really a utility-based type of discussion. Liquidity matters, of course it matters. You don't want to mismatch for sure. Inside of a managed solutions program, I think this is something that we're giving a lot of thought to, right? Is how you manage daily liquidity funds with this idea of lower liquidity in certain components of it. And right now, the regulatory bodies do allow that up to 10%, and I think that can be potentially a strategic advantage. I think for those that get there first and do it in a way that's thoughtful and has the most utility.
Well, you mentioned beta as being the kind of definition of how you think about it, whether it being traditional or alternative, right? And so how do you think about the more private markets when it comes to beta? And where I'm going with this is that there's always the joke, and I ran into a client that said, well, unlike your fixed income fund, mine's not down for the quarter. And I was like, well, what do you own? Like the whole area is that. He's like, oh, it's all private. I was like, oh, so it hasn't gotten marked yet, right? So that's the old joke, is that, because it's a little slower moving. So how do you think about the beta component of private markets? And like, do you even worry about it? Or is it that, that it's not marked contemporaneously, and so that lead lag allows you to kind of think about a little more diversification? How do you guys put that in a framework of thinking about these portfolio solutions?
Very topical question given the year we've had and how the marks have followed or not followed, I suppose, in the private space. Look, I got some
statements recently, man. I'm crushing it at the equity market. My private equity, my VC stuff, man. I mean, it's flat for the year. I mean, it's killing it.
Yeah. So, the way I think about the beta there is, for a lot of clients, like institutional clients, for example, it might be a feature, not a bug, right? Of unmarked volatility. And actually for many investors, in fact, I think you can view it as a feature, because if behavioral finance is a hurdle to overcome, then taking the irrationality of the market out of the valuations can be helpful. Where I guess it gets tricky is when you have such wide kind of separation between what you're seeing as kind of private valuations versus public valuations. You look at the REIT space, and for example, down something like 20%, whereas private real estate can be marked up in some cases. the way we overcome that, and so this circles back to kind of my manager research team, we really have to look carefully at the details, ask the tough questions on valuation, but also recognize that there's a bit of a subjective component to some of that valuation as well. Certainly, you want to make sure that there's an auditing process and everything else checks out, and so that's actually a very important feature of manager research. Even if it's not adding quote unquote alpha value, it's the due diligence value of making sure that there's a trust in these investments. And I think that's going to be the nut to crack, really, is before you have widespread kind of adoption of alternatives and privates and things like that, is gaining that trust. It's not so much about the returns; it really is about kind of believing the returns and believing the actors involved. So I think that's kind of the next frontier, probably from a retail investor standpoint.
Well, you'd mentioned the phrase, it's a feature, not a bug. And then you mentioned behavioral finance. Are you referring to the idea that potentially you can kind of save investors from themselves? That is, not selling at the bottom in markets? Or what do you mean by that phrase?
Yeah, that's it. That's exactly it. I think we're system one dominated, meaning our brains are wired to avoid danger whenever possible. And fear and greed are powerful forces. So anytime something you have a bout of volatility, you can see it. You guys certainly see it probably in your client questions. There are serious questions around things that in theory shouldn't even come up, right? Because if you're a long-term investor, you've bought into volatility, right? You've bought into it and you know it's going to happen. But when you face it, it's a whole different thing. It's the Mike Tyson quote of everybody has a plan until they get punched in the face, right? So I think private equity or private assets in general can take some of that effect away from investors. And so it's definitely a feature in that sense. If you can at least lag the volatility. I know 2020 is a good case study where private markets weren't necessarily marked down in Q1, whereas public markets were heavily marked down. But by the time you reach Q2, public markets were way up, but private markets were kind of right down the middle a little bit, or maybe even slightly flat to slightly negative, but took all the volatility out. And so you look at the two side by side 6-month returns, you probably had something much closer. And so to the extent that things turn around, I think that lag in valuation can really benefit investors.
David, I wanted to bring it back to the research, the manager research side of things. And both Sherman and I have been on the receiving end of you and your team with regards to your initial due diligence on us. And I just remember it being an extremely rigorous process, which I was very impressed with. But part of that offering your solutions, your portfolio solutions, is selecting those right managers in order to run and manage those strategies that you deem appropriate within those asset classes. So given your experience, is there anything you could perhaps impart on our listeners? Perhaps, I know you do it from an institutional end, but, with some of the carryovers that might be important for retail investors and thinking about various managers that run the investments the investment asset classes or, products that they might want to do. What kind of things would you look at when considering a manager? And just as importantly, what are some of the things that investors should, may get wrong in picking managers? Are there characteristics that they should be avoiding as well as looking for?
Yeah, how much time do we have? This could be a long one, right? This is stuff that I've thought about for over 20 years now in my career, and certainly our team does as well. I think it's more effortful than people want to believe. I think that's first and foremost. I think there's in our industry what's called the 4 Ps of manager research, which is a philosophy, people, process, past performance. All those things do matter, but it depends on how you approach those things. So I could say, those are the categories. Now just go out and find your view on those 4 different things for a manager. But if you're taking kind of a checkbox approach to it, you kind of you're going to be very descriptive, but you're not going to be predictive, which I think is probably the intent of going out and trying to do some research. And so this simple thing I would look at, like things like people, right? If you're just relying on an RFP type of approach, what are most people going to look at? They're going to look at credentials. They're going to look at academic background, experience, number of years of work experience, that sort of thing, intellect. And all those things matter, but only to a certain point. And once you get past that point, there's really no marginal return to it. So it's not really a differentiator anymore. And so what I think is more important is looking for humility from your manager, and that open-mindedness to know when they're wrong, because from recognizing that there's a lot of learning that can take place, and that's impossible to get out of an internet search or an RFP or things like that. So you really kind of have to talk to the manager. So think about every RFP response you've seen on sell discipline, or every pitch book you've ever seen where sell discipline is discussed. It's going to be one of three things. It's going to be price target was realized, or a better idea came along, or the thesis was disrupted, right? So nowhere in there is there, I'm wrong, because I'm wrong a lot of the times. As a forecaster of markets, I'm going to be wrong probably close to 50% of the time. Makes for lousy marketing copy for sure. And that's probably why you don't see that. But by talking to managers, you can understand whether or not there's that humility kind of embedded in that process. And the thing I point to often, so you don't have to meet a manager to do this. You could read their books if they happen to write books. Peter Lynch wrote a best-selling book on this, One Up on Wall Street, which was one of my favorite books early on in my career. And few would argue that he's not one of the greatest investors of our time. And in his book, he talks about the things that made him a good investor, obviously, but he also talks about the mistakes he made. But it's not the mistakes he made of commission. It wasn't, here I bought this stock and it was a dog and it was down, 80%. It was he had 2 pages in his book devoted to all the stocks that he could have bought that he didn't bought, that were 10 baggers, the things that he was looking to buy. And just the humility to actually spell that all out, to find that information first and foremost, and then to share that with an audience, just to show how fallible even one of the greatest investors in the world can be, I think is definitely something we're looking for, that humility aspect. And so what do investors get wrong when they're looking for managers? I think it's looking for confidence, right? I think that's how we earn trust of people. It's looking for overconfidence and believing kind of the more the more loud the forecast, the more believable it is. That type of approach. I think that's kind of counter to what we'd be looking for from a manager who's supposed to be more open-minded. And probably the biggest thing people get wrong would be looking at past performance and all of its variance. And for certain metrics that feel like it's the right answer, there's this concept called attribute substitution. Like, the real question we should be asking is, am I picking a good forecaster? But that's a really, really hard question to answer, because you have to do a lot of groundwork to understand that. And so really that's substituted by things like, what's this manager's active share, for example, which I know is kind of died down a little bit, but there was a time there where everybody wanted managers with high active share, because if you don't have different, if you don't look different than your benchmark, you can't beat the benchmark. That completely misses the point. It's like saying, if you don't take shots on net as an NHL team, you can't score goals. But what if your team is stocked with toddlers? If there's no skill in the first place, you're not going to score any goals, no matter how many shots you take on net. So you have to have skill kind of as the founding principle, and active share is almost irrelevant. R square is another one that people throw out there. If you it's the how much coefficient of determination does your portfolio have with the benchmark, and people want to see it be low. First of all, it means you're not invested in your asset class if it's too low. And a simple thought experiment: if you take 100 basis points and add it to the benchmark return for every single month for as long as you want, guess what your R square is going to be? It's going to be 100%. 100%, exactly. So simple thought experiment will tell you that how much does being active versus your benchmark matter to beating the benchmark? Very, very little. So it's classic system 1 at work. It's answering a different, more difficult question with a much simpler question, and being misled by that.
Well, so on that front too, when you're thinking about managers too, and I heard you say something about you want to be vocal and have a position, but not too much to where it's overconfidence. And so how do you kind of manage that with, you want someone to be active, you want to have this kind of lower R squared, but potentially be in the realm of the benchmark. Like, how do you think about that in this whole world of where people have been shying away of active because it's specifically in the US on equity, for instance, the benchmarks have done so well, right? Some people, we've had guests on here where we talked about being momentum and the likes, and just, you know, this the larger companies have kind of dominated in terms of earnings growth as well. So how do you put all this together? And when you're thinking about selecting managers, do you like to have a smattering of the concentrated, kind of the people who take the big bets, the low R squared, you know, they're going to have a high tracking error, or however you want to measure that, and measure that with some people that are more diversified? Do you think of it as an active passive kind of blend? You know, what is your current thinking on those type of mixes today?
Yeah, really good question. I mean, if you really want to get low on R square, you're talking about a hedge fund, right? You have like zero market exposure and hopefully a positive return,
Right.
But beta can be a powerful force, so it's hard to bet against that as well. I think what we're really looking for is the forecast at the end of the day, whether it's a traditional manager or a hedge fund, or even a private asset class for that matter. I think if you know, investing is in some ways trying to know a little bit more about the future than everybody else. And so that's the key ingredient for us. That kind of keeps us grounded. And if we find that, and it happens to be a, you know, kind of low R squared manager, and we have to balance that tracking error in our portfolio, we'll look to do that. We, you know, for some of our portfolios, you could think of, you know, kind of factor neutrality as being kind of a blend of different manager styles. So that you kind of take that noisiness of, is momentum going to be in favor, or value going to be in favor, or growth going to be in favor? You can take that noisiness out if all you want is the residual return of a good kind of forecasting stock picker. Unfortunately, that's also a very expensive way to kind of get beta in your portfolio as well, because you wind up paying full freight for active. So I think what we've been working on really has been a bit of a hybrid version of that, where it's core plus satellite. Where we want, you know, most of our portfolio to be focused on the things that investors should have as just good hygiene for investing for the long term. So stay diversified in your portfolio, stay focused on the long term, and then with, you know, a component of your portfolio, you might want to have a bit of a satellite exposure that's going to be a little bit noisier, and maybe prone to some of those, you know, beta effects. Whatever strategy you might be invested in, it might be out of favor, but over the long run, if you can believe in the investment philosophy, I think that that can be certainly beneficial to a portfolio. And, you know, so I think about, you know, leaning into, say, quality growth type approaches of equity mandates. That's a very popular style of investing, but it's believable, right? Because you're talking about buying companies that have higher returns on equity, and that hopefully can persist longer than the market's forecast. The market being, you know, quite short-term focused, whether it's next quarter's earnings or the next, you know, year or two. They're not looking out 7 years to see if a company's truly special enough to kind of defy the laws of capitalism and have that ROE be higher than the cost of capital for, you know, much longer than anybody would estimate. So that's probably a strategy that would be worthwhile kind of looking into from a satellite standpoint.
Okay.
So putting that all together, David, you're talking about a little bit of having a longer term view on your investment portfolios, or investors should have it, you know, that type of view, and, you know, certainly diversified. Bringing it all together, how are you thinking about asset allocation today, you know, for CIBC Asset Management right now in the managed solutions programs? Are there tilts that you're taking on? How are you thinking about you know, there's a myriad of geopolitical risks, you know, let alone economic risks that investors have to contend with right now. So yeah, how are you positioning for all of that?
Very carefully. There's lots of landmines out there. You know, the temptation is to do something, right? There's an activity bias when you see the volatility that we're seeing in the market. You know, if you told people what the setup was going to be in the month of July, you know, the Bank of Canada hike rates had a surprise, you know, 100 basis point hike. It was far higher than people expected. You know, the Federal Reserve has stayed on its course, and you know, we're already seeing the market kind of fading. And so you look at that setup and you say, okay, like, how are the equity markets going to do in this month, or how are the bond markets going to do in this month? And we've had a rip-roaring July, which is kind of defies maybe some of the expectations that you'd have with that kind of a backdrop. Look at 2020. If somebody, you know, told you in December of 2019, hey, we're going to enter a global pandemic and it's going to be horrific, and we're going to be doing things that we've never done before in our lifetime, certainly. How would you like to invest through that environment? I think a lot of people would have said, well, let's just go into cash, because there's a lot of uncertainty there. And that's kind of the point. There's uncertainty, meaning we don't know exactly what's going to happen, right? So we try to be measured. I talked about kind of the long-term strategic asset allocation process that we have. We try to estimate longer-term returns, and it's the differentials that matter when you think about kind of different growth rates for markets and different valuation starting points for markets and different dividend starting rates for markets. Those things can keep you a little bit more grounded in terms of what you think asset allocation could and should be. And then certainly when there's new news, you have to ask yourself whether it's signal or whether it's noise. And so we do have a tactical asset allocation team, a very talented team there that takes all the inputs or all the news flow and translates that into tactical asset allocation shifts. I will say this year it's a little bit different because we happen to be going through a strategic asset allocation shift as well. So interestingly, I think we're going to get some pretty good entry points also, because we're moving a little bit more into equity and picking our spots as well. So things like U.S. equity, which has grown substantially in terms of the market cap exposure in the global markets. I guess you could say stealthily, but probably not. If you've been paying attention to the performance, people should be aware that it's grown a lot. But it makes up something like 70% of the global market today. The U.S. equity market does in the benchmarks, in the developed market benchmark. So we've been kind of leaning towards the specialness of the U.S. market a little bit, leaning towards equities in general, the equity risk premium being a very powerful force. So we want to make sure that we have appropriate exposure there. At the same time, we're not ignoring kind of what's going on in the market. So I would say we've been doing that very, very carefully, which is kind of disrupted or not disrupted. I guess we are taking a tactical call at this point because, relative to our new strategic asset allocation, we're doing it carefully. So in many ways, we are in a bit of a defensive mode when you look at it in holistically.
So, David, you look at a lot of managers globally, and you sit from the seat too of having a big base in Canada, but you're very familiar with the U.S. markets too, and a lot of our listeners sit down here in the U.S. And so, what would be one kind of differentiated approach you think that potentially Canadian investors do differently? Again, I guess that's what differentiated means, but they do differently from the U.S. investors, and what potentially could our U.S. investors learn from that framework that the Canadians tend to use? And if I generalize there by saying all Canadians do it, I apologize, but you kind of get where I'm trying to go here. Is there a lesson that potentially a U.S. investor could learn from looking at investors in different seats?
Yeah, let me think about that a little bit. I mean, we're just as prone to home country bias as anybody out there. I guess in our case, it would be more meaningful than in the U.S. markets, where the U.S. market is such a big part of the global capital market. So, if anything, that I think introduces diversification. So you should invest more in Canadian stocks. Maybe that's one of the lessons. But in all seriousness, I think we tend to be more conservative, tend to be more careful in kind of new trends. So certain things like hedge funds certainly have been slower to pick up in Canada, which has not been a bad thing over the last decade when you look at kind of the results of traditional beta versus hedge funds, risk unadjusted, of course. Investors have kind of been okay being more conservative and not rushing into things and being a little bit more analytical. And I talked about kind of the foundations of our banking system and really looking to banks for leadership on a lot of these things. I think that's actually helpful. We saw it in 2008 with the housing market collapse in the US. That didn't really happen in Canada at all. So I think just by nature, I think Canadians tend to be more conservative, and I think that reflects also into our investment portfolios as well. So the lesson isn't necessarily be more conservative. I think it's just be more thoughtful in kind of what you introduce into portfolios and thoughtful about risk taking.
Okay. All right. Well, I think that's helpful too. I mean, again, the old adage is don't confuse the bull market with skill, right? So,
That's right.
people think they're risk takers, and then all of a sudden, you have some correction in markets, and people are saying, what was I thinking, right? Or, the dollar amounts get larger that you're putting into these areas later in the cycle. So I think that's very helpful. So David, before we let you go too, where do you, where can our listeners get in touch with you, get in touch with what CIBC does? What's the best way so they can tap into some of these thinkings that you have and what you put out there?
Yeah, there's some great thought leadership on our website, on the CIBC Asset Management website. So I'd encourage listeners to get on there. And then for me personally, LinkedIn is the only social platform that I'm on. So if people want to reach out there, I'm happy to talk.
Okay, excellent, David. So thanks again. Again, this is David Wong from CIBC. So you can find him on the LinkedIn as well. And we really enjoyed this today, David. But before you let you go, I got to introduce you to Sam's favorite part of the show. So Sam.
All right, David. And that favorite part of the show is called Sherman Says. It's where I will offer a series of alternating prompts between you and Sherman, to which I look to elicit a top of mind response that's concise. I'm going to give you we'll give you an example here of the first one out to Sherman of peak inflation.
Hopeful? That's what the low question mark at the end, Sam?
And a somewhat timid voice too.
Yeah. I mean, look, okay, now I'll go on my rant. So you take the Cleveland Fed, they got a nowcast for inflation. They have it coming down slightly, and it's back with a 9 handle by the next print. And so it's the second print. And that's right in the face of when the Fed meets again. So, you have this idea that inflation can roll down. But by the way, the year over year base effects are low. The roll-offs of those numbers are very low coming off the books. The upside, I guess, you have to the inflation argument is gasoline prices. I read this morning, it's the 47th day in a row that wholesale gasoline prices are down. So that, that's a lead lag with that. So that leads to the pump. So which leads to pressure downward for the next week or so on that. So ultimately that will help with some of the headline inflation, but it's tough. So that's why I say hopeful, but what does Jay do if, it stays with a 9 handle when he approaches the podium, at the September meeting? And I think that they have to go back to the unusual 75. So we'll watch the data set. There's a lot of data between now and then. So that's why I do hopeful question mark in an extremely timid voice.
Yeah, it's going to be an interesting summer there. So I guess right around that meeting is when they'll be the official close of summer.
Right, but then you have the other side where, like, you look at the Texas grid, it's like overly taxed. It's like the highest usage you've seen. There's triple-digit weather there again. It's like, I don't know. You kind of got to juxtapose those things together. So, it's the push and pull of inflation we've seen for the last, 18 months.
All right, let's keep it on that theme, David, with this one to you of inflation hedge.
Ooh, difficult.
All right, I hear that.
I always say buy, if you wanted the best inflation hedge out there, that's a good, stable return. You want to own a university because the cost of tuition goes up at a similar rate every year. Don't know how to institute it. You can email us at shermanshow@doubleline.com if you have an answer on how to do that one.
That was the old Warren Buffett was asked, what's the best inflation hedge? And he said knowledge, right? So it's the exact same idea.
Yeah, exactly.
All right, Sherman, I'm going to work off your little question mark that you gave on that first response to the Sherman Says with Powell pivot.
Debatable. As you see, I'm not a buyer. I'm a seller of the pivot at this point.
Yeah, I tend to be on that same page there. All right, to you, David, with neutral rate of interest.
Gosh, scary. Scarily higher.
Yeah, I think higher too there. Back to you, Sherman. Let me see. I lost my place here.
Although Powell didn't seem to say that, David. Powell tried to say we're close to neutral.
You said we're in the range of neutral.
Yeah, that's true. That's true. Range. And also, but is that long term or is that contemporaneous too? Do we need to be higher in this kind of environment? So.
Yeah, well, we got to leave room for policy error, right? That's going to happen too. And so, yeah, scarily higher.
Absolutely. Let's see here. Who are we on? Sherman, job openings.
Wow, this precipitous drop today in JOLTS. It declined about 500,000 of openings. And so I said to the team this morning, and you saw that, Sam, did they get filled or did they get killed, using the old trading adage? And so, I guess we'll find out on Friday at part of the jobs report when we see that with non-farm payrolls, which is expected to be north of 300,000. So we'll have to see if that's, definitely just a planning pullback, of those openings, or were they actually getting filled? And so I think it's a little column A, a little column B. So, this is the slowdown Jay wants, though, too, right? So again, this is the thing that, he perversely says that he cares about the American public, but these policies are inherently to try to drive unemployment higher.
Yeah, I guess the FOK and that becomes the FAK then if you're doing columns A and B.
There you go, fill and kill. So yes.
Right. So over to you, David. ESG, if you want to take it, or you can pass. I don't know. Some people pass on that.
Important.
All right.
Important.
Risk assets.
Important. Look, we've had a great rally. If you own too much risk, good time to trim a little bit. Make sure you're ready for this next season, because I don't think volatility is subsiding here. And so I think you got a good chance to resculpt a few things. If you didn't own the rally, maybe you don't want to be a buyer at this point. But if you're a renter, probably a good time to true up a little bit. So look, I think this is a highly correlated market right now. As we've seen the July rally that David mentioned earlier, it was a global rally. It was a global rates rally. Spreads tightened in across most fixed income sectors. Equities did well. This is not a market where correlation's your friend. Everything's moving together. And you can see today on something where we're talking about inflation coming back again. You have a Fed governor out speaking. All of a sudden, bonds get hit in the US pretty hard today. So, risk goes the way rates go right now. And so, again, it's just going to be a little challenging. I think we got a little over our skis in the rate rally, and I think we're getting back to a more normal range. So we'll see how vol is going to be driven by inflation, as Sam, I've been talking about for many, many months now.
All right, back to you, David, with Canadian housing market.
Precipice. I think it's an interesting time for the Canadian housing market with rates where they've traveled and where they might continue to travel. So I think we're starting to see a slowdown for sure.
Hey, David, what do you know roughly? And again, you can say you don't. Roughly, what percentage is floating rate mortgages in your country? Is it like the European market where it's almost predominantly that driven by that, or do you have a fair amount of fixed rate mortgages too, where those homeowners aren't as impacted by this rate move?
So anecdotally, I would say a lot of floating.
Okay.
People have been making that interest rate bet for a very long time and winning.
It's not a structural thing. It's an option though, right?
It's an option. Yeah. You have a choice. And so I'm a bit of a chicken. So I've always been a fixed rate guy myself, but a lot of folks choose that variable rate because of the secular decline in rates. They've been winners up until now. So it's it's an interesting situation.
Okay.
All right, Sherman, with OPEC plus.
Who? Still relevant. I don't got anything clever to say, Sam. You got me.
Nobody told me that was the objective of the game.
Oh, Sam loves to do that to me, but that's just because we have too much of this. But I just don't have anything clever to say about OPEC Plus today.
Yeah, I would say I kind of know your buttons. We work together too long, too much. I know to get some trigger words from you. So, all right, let's go over the last one and to wrap it up, David, with Toronto Pearson Airport.
Disaster. It's not a good situation there. As I would not think about traveling for vacation travel myself anytime soon, because I'm not the kind of guy that has the patience for what's going on there now. But things like deplaning, people have to have to sequentially do it, and it's all kind of orderly, but I think takes a very, very long time to get anywhere.
Yeah, I've had an experience flying recently where I went to the airport and the pre-check line, which is usually significantly shorter, and it was shorter than the other line, took almost 1 hour to get through. And the other one was the general line was taking close to 3 hours to get through. So even those people who are told 3 hours before your flight, obviously this was very understaffed and not efficient whatsoever, but people held it together. So for all the horror airport stories that I've seen and read about, at least this one, people are being behaved that day. So I'm thankful for that. So David, really appreciate the time. It's great to see you again. I know we're not in person today, but we will be making the trek your way. So can't wait to see you in person, catch up as well. Thanks for taking the time. Again, David Wong, CIBC Asset Management. You can catch all of our podcasts on iTunes. We're on Google Play. We're on SoundCloud. We're on Spotify these days. Sam, we got anything else we're on? Some other stuff?
Everywhere you want it to be, or just let us know via email or the Twitter.
Okay, there you go. And we're on the Twitter. As Sam said, we've lost a few followers last week as I looked at the numbers. So sorry for whatever we said, people. I guess you won't be hearing this, so it doesn't really matter. But anyway, if you're not following us on the Twitter and you want to see recaps, we put out some macro stuff as well at Sherman Show Pod. And you can also follow Sam on his other podcast, which I won't promote today. But Sam, what's the Twitter handle for that other one?
DL Minutes.
DL Minutes. So again, thanks everyone. Thanks David for the time. And we'll be back at you in 2 weeks with a new podcast. Take care all.